15 of 21 series are aligned with a mild stagflation configuration this morning. That is a majority reading, suggesting the framework sees a meaningful but not unanimous clustering of conditions. The current macro regime is stagflation mild, with a confirmation score of 15 out of 21. In this macro regime, the engine is observing growth momentum decelerating at a rate of about -0.16 on its normalized scale, while inflation momentum is accelerating at roughly plus 0.02. In plain terms, the data underneath point to activity softening at the margin while price pressures build rather than fade. The coherence score is in a moderate band, meaning the 21 series agree enough to form a consistent picture, but there is still cross-current rather than a fully locked-in state. The confirmation score of 15 out of 21 has, in our historical sample, coincided with this regime persisting in roughly 41% of comparable 3-month windows, with the most frequently observed next state being an acceleration regime. Compared to last week, confirmation has held steady at 15 series, while the growth side momentum ticked slightly more negative, and the inflation side nudged a bit higher, reinforcing the mild stagflation reading. Historically, environments like this have felt choppy across markets. Headline indexes often moved sideways. Defensive sectors and real assets held their ground more often than not, and cash earned its keep in the record we studied, a description of past behavior, not a roadmap. Let's walk through 4 signals the engine is watching under this backdrop. The first is the Treasury curve. The 2-year Treasury yield, a proxy for short-term policy expectations, sits around 4.18%, while the 10-year yield, reflecting longer-term growth and inflation views, is near 4.55%. The spread between them, about 0.39 percentage points, has been steepening, and the framework labels this green momentum for the curve, defined as the 10-year minus 2-year spread, widening by more than 10 basis points over a rolling month. Markets watch this because a steepening curve often signals shifting expectations around growth, inflation, or policy. The question it raises is simple. Does a steeper curve change how much term risk, duration, or cyclicality investors are comfortable carrying? In our framework's reading of comparable periods, this roughly coincided with firmer inflation measures and more mixed equity returns within 3 to 6 months, an observation under our methodology, not a forecast. What would challenge this read is a renewed flattening of the curve driven by either falling long yields or rising short yields that compress the spread back towards zero. The second signal is labor. Non-farm payrolls, a broad measure of hiring, have cooled from earlier in the year, and recent commentary from policymakers has described job creation as having nearly stalled, even as the unemployment rate holds near a stable range. Markets watch the labor data because it anchors the income side of the economy and shapes how both consumers and companies respond. The question it raises is whether slower hiring changes how much earnings risk or credit risk investors are comfortable accepting. The framework currently marks labor as red momentum, defined as a configuration where payroll growth slows by more than 0.5 percentage points over a quarter while unemployment stops improving. In our framework's reading of comparable periods, this roughly coincided with more cautious behavior in cyclical sectors and a tilt toward quality balance sheets within a 1 to 2 quarter window, an observation under our methodology, not a forecast. What would challenge this interpretation would be a clear re-acceleration in hiring or a fresh decline in unemployment that signals renewed strength in labor demand. The third signal is credit. High-yield credit spreads, the extra yield investors demand to hold lower-quality corporate bonds instead of treasuries, have widened modestly from recent lows but remain well inside stress territory. Markets watch this because it reflects how much compensation participants demand for taking default and downgrade risk. The question it raises is whether a slow drift wider in spreads alters how much leverage or credit exposure feels acceptable. The framework currently tags high-yield credit as yellow momentum, defined as spreads widening by 25 to 75 basis points over a rolling month without crossing prior stress extremes. In our framework's reading of comparable periods, this roughly coincided with a mixed pattern of equity returns and selective pressure on the most indebted issuers over the following several months. An observation under our methodology, not a forecast. What would challenge this view would be either a clear tightening in spreads back toward cycle lows, or conversely, a rapid blowout that pushes spreads into historically distressed ranges. The fourth signal is equities, with a focus on sector rotation. Technology benchmarks are marginally higher, energy is modestly positive, while financials, healthcare, materials, and industrials are all somewhat softer. Markets watch this cross-sector pattern because it shows where participants are allocating risk within the equity market. The question it raises is whether the current tilt between growth sectors, defensives, and cyclicals fits each investor's tolerance for concentration and style exposure. The framework reads technology as near flat, energy as green momentum, and several cyclical sectors as red momentum, using definitions tied to whether sector indexes have moved more than roughly 3% over 10 trading days in either direction relative to the broad market. In our framework's reading of comparable periods, this roughly coincided with sideways index performance paired with notable under and outperformance at the sector level within 1 to 3 months. An observation under our methodology, not a forecast. What would challenge this pattern would be a decisive rotation, either back toward cyclicals or into deep defensives that breaks the current mixed profile. The conditional map adds another layer of context. If the 10-year Treasury yield crosses 4.45% and holds that level for 5 consecutive sessions, in our framework's reading, inflation composites showed acceleration in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. In a mild stagflation regime, that kind of sustained move in the long end would mark a stronger price pressure signature under the math. If the fear and greed index, a blended sentiment gauge, drops below 15 and stays there for 5 sessions, in our framework's reading, the regime confirmation score deteriorated in roughly 7 of 9 comparable conditions, a historical characterization, not a forecast. In this environment, such an extreme sentiment reading would have signaled greater fragmentation in the 21 series historically. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework, price structure, rate of change, risk regime, and market participation across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, Atlas records it as an upside-aligned or downside-aligned condition under the framework. A reading of how the 4 layers line up, not a trade. These are time-stamped model readings logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols, the 4 layers do. Members use Atlas to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what to do next. Those readings are framed as potential, educational. Context to help people think, not instructions on what actions to take. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.